Hi, I'm Jacob Reeves, a senior tax manager here in our Newport News office, and we are going to be going over some business provisions of the One Big Beautiful Bill Act here.
Hello, I'm Kevin Forget. I'm a tax manager in the Charleston office of Brown Edwards and Company. We are excited to be going over the business provisions of the One Big Beautiful Bill that was passed July 4th, 2025. As some refer to it as OB3, so we may or may not interchange how we're referring to the bill, but there's a ton of information in here.
Yeah, so they actually expanded some opportunities here for a lot of our clients who are in the construction industry. Under prior law, if you were sort of a housing construction, just single family homes, were allowed to use completed contract method rather than percentage of completion for those construction contracts. That really allowed you to time your income a little bit better, defer some income, accelerate some deductions. It's also just a little bit easier to calculate. Now that has been expanded. So now anything residential qualifies. This is multifamily apartment complexes, condo buildings, long-term care facilities. So you're not now talking just your little single family homes being built that qualify for this exception. It's opened up to a lot of residential contractors.
It's just another key component of expanding domestic production, manufacturing, construction. It's excellent.
Yep. Okay. So, hot button issue, especially when the first tax reform came out a few years ago, was opportunity zones. These have now been extended and made permanent with a reassessment on them every 10 years. They are redefining a low-income community with this new release to try and actually make it target a little bit more. The first one that came apart, they just said, states, give us your tracts, we've got to come up with something. So a lot of states had some other programs that they were already running and they copied those maps over. So I know we had a tract here in our backyard that made no sense that it was an opportunity zone because it's been so developed from other incentives over the past 5 to 10 years. So they sort of looked at that criteria and said, okay, we need to reassess it a little bit, and came up with these criteria and thresholds. So they did re-up the ability to get some gain deferred tax-free completely on some of these deals. Under the old one, you had to get into an opportunity zone investment by a certain date to really see all the benefits out of it. Now they kind of made it work on a rolling basis since they did make these zones permanent, so that way you are getting those tax benefits. They did re-up how much you can get on those deferred gains, so it is a 10% increase after 5 years, but then they added a new category of qualified rural opportunity properties. So that up to 30%. So if you're in a more rural area, you might be able to look at those and get higher step ups in those amounts kind of as you go. So, and then that qualified rural opportunity fund is defined as a business and a tract that's not in a city or town greater than 50,000 residents or any urbanized contiguous area.
So the low income housing tax credit, these enhancements have been made permanent. It does require, it reduces the requirement for bond financing from 50 to 25%, and these are all effective after 12/31/2025. So beginning next year, if you are looking at low income housing tax credits, there is a lower bond financing percentage. Is really the main takeaway from this change to the bill.
Yeah, and the fact that they just re-upped it so we can continue using this provision to kind of help those developments.